Imagine this. You're at a weekend barbecue. Someone's glowing with pride because they just made their last mortgage payment. Everyone's cheering, clinking beer bottles, and praising them for being so financially responsible. But across the yard, the wealthiest couple at the party stays quiet. They smile politely, but they don't join the celebration. Not because they're jealous or can't afford to pay off their home. It's because they know something most Americans over 50 don't. And it might completely change how you think about money. Here's the truth that might surprise you. Wealthy people almost never pay off their mortgage early, especially not after turning 50. And if you're racing to pay yours off, you could be walking right into a huge money mistake. I'll explain why the rich look at debt differently, why having a paid-off home might actually be costing you hundreds of thousands of dollars, and what you should be doing instead. This isn't just a theory. It's how real wealth is created and protected later in life. Let's start with the first important insight, the false lesson many of us learned growing up. For years, we've been taught one clear rule: pay off your mortgage, own your home, and you'll sleep easy. Maybe your parents even had a burn the mortgage party back in the 80s. Maybe you've dreamed of the day that payment disappears for good. But here's what no one tells you. That dream was designed for a completely different time. In the 70s and 80s, mortgage rates were sky-high, 12%, 15%, sometimes even 18%. And savings accounts paid interest between 5% and 10%. Back then, your house wasn't just where you lived. It was your main financial investment. So paying it off made perfect sense. But times have changed. You're following your grandfather's advice in a world your grandson will live in. Today, mortgage rates are much lower. Investment opportunities are everywhere. The economy has shifted, but the advice hasn't. I spoke with a financial advisor in Austin who said the biggest mistake he sees from clients over 50 isn't that they haven't saved enough. It's that they let emotions guide their money choices instead of using strategy. And the most emotional choice? Rushing to pay off a mortgage that could actually be helping you. Here's the second wealth killer, the hidden cost inside your own home. When you pay off your mortgage, you're not removing a cost, you're creating one you can't see. A hidden loss. Every dollar you put into your home is a dollar that's not growing, not earning, not building on itself. It's just sitting there, like money under a mattress. You wouldn't keep an employee who shows up every day and does nothing. That's what home equity is, money that's doing nothing. Let's say you have $30,000 of equity in your house. If that money was invested and earning just 6% a year, you'd be missing out on $1,800 every year, about $150 every month. And that's every year, not just once. Rich people figured this out long ago. They don't think of a paid-off home as safety. They see it as money sitting around doing nothing. Here's a real story. Daniel from Oregon called into a radio show I was listening to last month. He was 62 and had just paid off his $400,000 house. He was proud. But when the host helped him run the numbers, Daniel realized he was losing about $24,000 a year in possible returns, $2,000 every month he could have earned. Sound familiar? Have you ever worked out what your home equity might be costing you in lost chances? Now you can see why wealthy people think differently. They don't see home equity as security. They see it as idle money sitting there while inflation eats away at what it can buy. Are you starting to see your home equity in a new way? If so, type eye-opening in the comments. I want to know if this is changing how you think about your biggest asset. Now for the third trap. The cash crisis no one talks about. This is especially serious after 50. The biggest danger isn't having a mortgage. It's believing you're safe because your money is tied up in your house. You can't sell a bathroom to pay for surgery. You can't cut off a piece of your roof to pay for long-term care. You can't write a check with your kitchen cabinets when your kid needs help. You could have $500,000 in home equity and still be broke when an emergency hits. I've seen it happen. A couple retires at 62 with their home fully paid off. They feel secure, like they did everything right. But then a health emergency happens. Or the market drops when the roof needs replacing. Or a family member calls needing help. Suddenly they have no cash. They're retired, can't qualify for loans, and don't want to sell. Now they're stuck, trapped in their fully paid-off home. Wealthy people understand something key. Cash flow is like oxygen for your money life. After 50, when your income becomes uncertain and expenses pop up unexpectedly, having liquid cash isn't just helpful, it's critical. Take Raymond from Georgia. He owned his house outright and felt financially stable. But then his wife needed emergency surgery, and insurance didn't cover everything. He had $600,000 in equity, but couldn't easily use it without dealing with slow banks or taking high-interest emergency loans. That's when he learned the hard way what rich people already know. Liquidity, having access to cash, is everything after 50. That's why they keep mortgages. Not because they can't pay them off, but because they want options. Real safety after 50 isn't about paying off debt. It's about staying flexible so you can handle anything life throws your way. Now let's talk about the fourth hidden advantage, the tax break no one talks about. Your mortgage isn't just a debt. It's a powerful tax tool. When you pay it off, you're giving up one of the few remaining ways for regular people to lower their taxes. If you still itemize your deductions, especially in states with high living costs, mortgage interest can reduce your taxable income year after year. But there's a bigger benefit most people miss. When wealthy people need money, they don't sell their stocks or pull from their retirement accounts. That would create a tax bill right away. Instead, they borrow from their home equity using a low-interest loan or home equity line. Here's the best part, borrowed money isn't taxed. No capital gains. No early withdrawal fees. No higher tax bracket. A financial planner in Nevada told me about a client who needed $50,000 for his daughter's wedding. Instead of selling investments and paying $10,000 in taxes, he used a home equity line of credit at just 3.2% interest. He kept all $50,000, and his investments kept growing. That's why wealthy people keep their mortgages. It gives them quick, tax-free access to money when needed, without causing tax problems. They're not breaking laws or avoiding taxes illegally. They're just smart about not creating tax bills when they don't have to. It's not about avoiding debt. It's about using your own money in a way that keeps more of it in your pocket. Here's the fifth hidden benefit, how inflation quietly helps your mortgage. This part is rarely discussed, but once you get it, you'll never think about your mortgage the same way again. Your fixed-rate mortgage is one of the only kinds of debt that gets easier to pay over time. Let me explain. Imagine your mortgage is $2,000 per month today. If inflation is just 3% each year, then in 10 years, that $2,000 will feel more like $1,500 in today's dollars. In 20 years, it'll feel more like $1,100. You're paying the bank back with money that's worth less and less each year. It's like you have a silent helper who gradually pays more of your loan while you do less. This isn't some fancy trick. It's just simple economics. Wealthy people understand and welcome this, while most others fight against it. A Japanese business owner once told me, Americans fear debt and inflation. But smart investors know that if your debt has a low fixed rate, inflation is your friend. Why pay it off now with valuable dollars when you can let inflation do the work? If your mortgage rate is under 4% and inflation is 3%, your real cost is just 1% or less. That's like borrowing money for almost nothing. That's a gift. And the wealthy happily accept that gift while others throw it away by paying off cheap debt early. Let's look at the sixth real-life example, the $200,000 mistake. Meet Lisa. She's a 52-year-old teacher in Indiana. She owes $200,000 on her mortgage at a fixed rate of 3.5%. She also has $200,000 in savings and is thinking of using it to pay off her house. Sounds smart, right? No debt, no monthly payments, just a fresh start. But let's do the math. If she pays off the mortgage, she saves $130,000 in interest over 15 years. She owns her home and feels secure. But if she instead invests that $200,000 in a balanced portfolio that earns 7% annually, which is very realistic, her investment grows to $550,000 in 15 years. She still pays the $130,000 in mortgage interest, but she ends up with $220,000 more than if she'd paid off the home. She thought she was being careful, but in reality, she lost more money than she saved. That's not smart finance. It's a costly mistake disguised as responsibility. Which of these traps have you fallen into? Share your experience in the comments. It might help someone else avoid the same errors. Now let's wrap up with the 7th part, the wealthy person's mortgage game plan. Here's the 4-step method rich people use, especially after 50. Step 1. Keep mortgage rates under 4% for as long as possible. If you've got a low fixed rate, don't mess with it. Hold on to it, it's a valuable tool. Step 2. Invest the money instead. Don't just skip paying off the loan. Put that extra money to work in stocks, income-generating funds, or real estate investments. Even a 6 to 7% return will beat your mortgage interest easily. Step 3. Keep at least a year's worth of mortgage payments in savings. This is your safety cushion. It lets you sleep peacefully, knowing you're covered if something unexpected happens. Step 4. Check in once a year. Ask yourself, is my investment still growing more than my mortgage is costing me? If the answer is no, adjust. But make that decision based on today's reality, not old advice. This mindset isn't fantasy. It's what financially free people over 50 do. They may still have a mortgage, but they have zero financial stress, because they know how to use debt wisely. Now, maybe you're still wondering, but won't I feel better knowing my house is fully paid off? Sure, it feels good. It feels like a win. But I've spoken to many people in their 60s who own their homes but don't feel secure at all. Because they're house rich but cash poor. No flexibility. No buffer when life gets hard. Take Martin from Colorado. He paid off his home at 61 and felt proud. But then winter came, his furnace died, his roof leaked, and his adult son needed money. Martin had $400,000 in equity, but couldn't get to it fast without high-interest loans or a complicated refinancing process. Real peace of mind doesn't come from paying off everything. It comes from having access to cash, earning passive income, and having options when life surprises you. That's why wealthy people don't rush to pay off their mortgages. They use them as quiet tools to grow and protect their wealth. Your future after 50 isn't about using outdated advice. It's about asking better questions. Not, can I pay off my mortgage? But, should I? Not, how much interest will I save? But, what opportunities will I miss if I lock up this money? That's the mindset shift that separates people who just get by from those who build lasting wealth. Once you flip that mental switch, you'll never see your mortgage the same way again. It's not your enemy. It might actually be your biggest financial tool if used wisely. So what's your plan from here? Will you pay off your house, or invest the money and let your mortgage work for you? On a scale of 1 to 10, how helpful was this information for your financial future? Drop your answer in the comments and let me know how this is reshaping your next 20 years. I read every message. Your thoughts often inspire future ideas that help others build true wealth and freedom.